Hi guys, welcome back. In previous classes, we have completed the definition of the plant and machinery and the recognition at initial state and subsequent costs. And what are the measurement at the recognition, what are the cost involved in that measurement, how to measure that cost, and, and post that, what are the measurement after recognition and how to do that. In that we have completed this revaluation model, cost model, and revaluation model, and the revaluation model also how to account that revaluation surplus account, and how to utilize that revaluation surplus account, and how to transfer that revaluation surplus account to retained earnings account we have completed. Now we will complete this depreciation, impairment, and all, and then the derecognition, disposal. Apart from this, appendix A to Ind AS 16 also added this time. So these will complete in the future classes. But today's target is depreciation and its treatment. So yesterday class we have completed this. How to we utilize this revaluation surplus account at the time of disposal or derecognition, or at the time of additional depreciation during the usage of the same PPE, same plant and machinery, while you have revalued and used for further years. During that you will get additional depreciation because of the revaluation, and that revaluations are the difference is the additional depreciation. That additional depreciation should transfer from revaluation surplus account to retained earnings. So this we discussed in the earlier class. We have completed our examples. Okay, today's class we will start about depreciation. First of all, what is depreciation under Ind AS 16? What is depreciation and how should you account that? So the definition of the standard is depreciation of the PPE is an systematic basis over its useful life. Okay, systematic basis means, say suppose you have an PPE, you you accounted that PPE for 1 lakh, and this useful life is 10 years. 10 years. So the usage would be same. Assume that you can use this PPE for this 10 years in the same manner. Same manner means, say suppose you, the PPE name, the class of this PPE is furniture. So this furniture you can use for 10 years in the same manner. You don't need to produce extra, or based on this furniture your production will not affect, and this like. So this is an usage of the furniture. How it would be, either you put this in the office building or corporate building or other any warehouse building, wherever required for the facilitating the employees to use that. So this is PPE. The useful life is 10 years. That is why we should capitalize under the Ind AS 16. But what we do depreciate out, what we do depreciation time, and how we have to do the depreciation during this useful life. So the useful life is 10 years, and how do we systematically allocate this 10 years cost, to P&L account. Say suppose 1 to 10 year. So during these 10 years, you have to systematically allocate this 10 lakhs, this 1 lakh to 10K each month. So this systematical allocation is called depreciation under PPE in Ind AS 16. I hope you understand this. And the useful life, what is the useful life? This useful life will change through asset to asset. Say suppose it has the same asset and different lives. Let's have different life. Say suppose you bought one land and building. So if you observe, land have infinite useful life. So you don't need to depreciate for land. But building, you can have a value of 30 or 40 or 50 years based on the quality and the review report. But you took that building as a rent in case the rent as a time. So land and building, whatever you say, suppose this is an entire flat, in this only part of on 25th of the 25th percentage constructed building and 75% is empty. So you took this as rent. So the rent for this, I mean the leasehold property value is yearly you are paying 10 lakhs per month. So yearly 1 crore 20 lakhs you are paying. So in this you can't bifurcate land is 75%. So because this land is also as a term, as a useful life of 10 years for you. So in that case you can depreciate land. But if it is an own property and you bought that land and you are the owner of that land, you cannot depreciate that land because of the usage, because land will not depreciate. So land is a non-depreciable item. So the same asset as an different useful lives. See, land has no useful life. I mean no dep- no useful life means you can use n number of years. But building as an useful life. So you can differ. I mean you can differ this for different items in the same. Say suppose you can take aircraft. In aircraft there is an airframe and aircraft mission. The aircraft mission generally replaces in 3 years, but the frame, the entire frame and the windows, that you can use 10 years. So you should allocate the depreciation in different useful lives and different parts and manners of that particular PPE. I hope you understand. So I have given here systematic basis of the useful life. Same message as different lives also. This is of aircraft, land, and everything. Most of the cases, land is unlimited. Land has unlimited useful life. So you do not need the depreciation for land unless if any cost incurred in the land like site restoration, removal of restoration, or dismantlation of the asset, that portion of that cost of the PPE is in depreciation for the useful life. Say suppose you have a 75% of land, you need to, there is a land here. So you constructed one factory building. So this has in 20 years time. This is the building part. And then in the balance you should incur few expenditure to facilitate this factory building. You have created 1 2 3 4 blocks. In that blocks you created some facilitation activities to do the factory building. So in these situations, in these four cases what you incurred here, so here you have incurred few costs. And this you have to remove while you removing this factory building. This you have to remove this facilitating activities after 20 years. So this is an side dismantlation expenditure, and you should restore this as a regular land because of the economic sake and as per the government rule, either contractual or legal provision. In that case, the cost you are incurring here would be the useful for next 20 years. So that will anyways you should add that. Apart from that, there is a dismantling cost for in this land. So the provision for the dismantlation also will add to that PP. We have discussed in this in part 2 or part 3 in detail. So you can go through. So that case you can depreciate that portion of the dismantling cost, everything that you can depreciate. Okay. I hope you understand this. And then what is the formula for depreciation? In the depreciation, what is the formula? Say suppose the depreciation formula is cost or fair value of PPE minus residual value over useful life of useful life of that PPE. Okay, PP1, PP1. So this is the formula for doing the depreciation of that asset. I hope you understand this formula. In this we should find why we are using cost or fair value and everything we understood now. Say suppose you are using cost model and you are using revaluation model. So now you can understand, right, what is the cost model, what is the revaluation. You can easily understand now. So in the cost model, in the cost model, PPE cost is cost you have incurred plus additions if any. So that's why you have used cost here in the formula. Okay. In the revaluation model, you should revalue your asset at the fair value. In case if you have revalued during the period, in those cases the depreciation should calculate on the fair value, not on the cost. In the revaluation case, that's why I have used cost or fair value. So if it is a cost model or a revaluation model, but in this you didn't do the revaluation till now. Say suppose there's a 2 years period for your revaluation, so you can take cost in the revaluation model also because you didn't do the revaluation. But if you did the revaluation earlier, so you should take fair value. That is why I have here cost or fair value, and then residual value. What is the residual value? Residual value means an amount that entity can able to recover remaining value at the disposal of the time. Say suppose if you have an PPE, say you have a vehicle, say suppose car, you have a vehicle, this is car for now. So after 5 years, you can sell in the over the you can sell this car in secondary market or whatever wherever possible. So you can able to recover 2 lakhs, but the value of car today is 25 lakhs. Okay, this is the residual value you can recover. So in those situations you should take the residual value also while calculating the depreciation. You should not account the residual value elsewhere. Just to calculate the depreciation, to calculate the depreciation you should consider this residual value in the calculation purpose. So in both fair value valuation or cost model, everything whenever the residual value should take. I will give few points about residual value. Residual value means there is at the disposal of the amount that can entity would currently obtain for from disposal of that particular PPE. So if it is an, say suppose this residual value would be 0 because some assets may not residual value in future, so it can be 0. Okay, but as per schedule 2 of the companies act, and which is issued by the MCA, so you can you can value this residual value up to 5% of the PPE, up to 5% of the PPE. So 25 lakhs, what is the 5% on 25 lakhs? This 1,25,000 you can till you can value till 1,25,000 as a you can consider the residual value till up to 5%. If but you can able to justify that I can able to sell this car at 2 lakhs and I haven't secondary market that this today's date and I will put an inflation and everything, I can easily get the secondary market 2 lakhs. So you can able to justify that thing. Then you can value your residual more than 5% also. So generally 5% there is no justification is needed. So you can easily reduce your value, but more than 55% you should do the justification. And then what is the residual value? Say suppose expected sale proceeds at the time of disposal less expected cost of disposal to get the proceeds. This is the residual proceeds. So the sale of an PPE at the disposal and then expected cost of the disposal. So this you should consider as a residual value. I hope you understand. Generally, you see how you account your PPE. So this is the important. Then in standard or PPE there is nowhere mentioned this, but in the disclosure you should do this first. You should disclose like this in the grass level. In the grass level, opening, in additions and deletions, and then closing grass account, grass PPE. In this class wise, plant and machinery, buildings, computers, TV, every class will come here. And then class 2, what is this? Accumulated depreciation. Accumulated depreciation also, opening accumulated depreciation, additions during the year and deletions during the year, and closing accumulated depreciation. And then net also will come. Net also opening carrying value and closing carrying value. You don't need to tell these additions and deletions in the carrying value. So this is how you should show your PPE schedule. Say suppose this is a table, the the parts are like this, and then you have to identify their gross accumulated depreciation and carrying value or net value of PPE. This particularly opening gross value, additions, deletions, and closing gross value. And then opening accumulated depreciation, additions in the depreciation and deletions in the accumulated depreciation, and closing accumulated depreciation. Here closing carrying value and opening carrying value. This minus this is opening carrying value. This minus this is, say suppose 1, 2, 3, 4. Yeah, 1 minus, sorry, 2 minus 4 is your closing carrying value. 1 minus 3 is your opening carrying value. So this is the schedule, the FA schedule you should do. In this, this residual value will calculate at the time of depreciation. I hope you understand this. And then what is the useful life in your definition? The useful life generally will take into the consideration, because the third part of the formula is you have completed cost or fair value minus residual value you have completed, then useful life. The generally useful life is the over the period of useful life, what is the expected useful life for your entity in the intended purpose. Say suppose you took a building for admin office purpose, so you can use that building for 20 years. So this is 20 years is so office purpose, and then in a 21 year you should sell that building in the second market, and you want to buy the new building in the 21 year. But you should have an hold that asset for 21 year also, for because for name sake, also for the inflation characteristics and the marketing conditions, you can hold that building also. But you should not consider depreciation for 21st year, because the intention to use for office purpose is for 20 years only. For 21st year, you classified that as sale, held for sale. You held that asset for sale in 21st year. Your intention of the PPE is not to use for office purpose. It is used for selling purpose. So in that case, for 21st year, that 1 year, you cannot consider for depreciation purpose. That is what the period over which the asset is expected to be available for us for usage of an entity for its intended purpose. We discussed about this intended use. So what is your intention at the acquisition of that time? There are a lot of examples for this intention of the management. We have discussed in the previous classes also. So I hope you recollect that data, everything. So the intention of this PP is important. So, and number of production or similar units expected to unit the value in production. So this point I will tell in the depreciation method stem. Say suppose how many number of production units or similar units you can able to generate. So this is called production uses method. That's why I have concluded here. So what is your intention? You say suppose you have an car, so you want to use that car for office purpose till 15th year. In the 60 post 15th year, you want to sell that car. When the car you offer that sale to few secondary markets, but the car is sold in 18th year. So these 3 years you didn't use our car, or you may use for few purposes, but still the intention is not to use for business purpose for after 16 years. So whenever the intention is changed here, no, you cannot consider this 3 years time for depreciation calculation. You should consider what is your intention to use that asset till that date only. Consider for depreciation calculation. Post that, even though if you use for office purpose for a minimum period of time, till you didn't consider that usage for the depreciation. Okay. And while we doing the depreciation calculation, there are few points to consider that I will explain. You should review the residual value. You should review the residual value over its useful life and its useful life during the period of the depreciation. And in the systematic allocation, there is 10 year, right? This 10 years. So you should not maintain the first year assumptions in the 10th year or in the 5th year. You should review these years. So how should we do? At least each financial year end, you should review the changes, if any, as per the Ind AS 8. Say suppose in the 5th year, you are in the first year you calculated useful life is 10 years, and then in the 5th year you saw the PPE's condition. You analyze that we can able to use for next 3 years only. So what it says that instead of the remaining 5 years, you can able to use for 3 years only. So in that case, the total useful life changed to 8 years from here. So this is an change in accounting estimate. So you can account is under Ind AS 8 on prospective basis. So in the 6th, 7th, and 8th year, you should change this calculation. So that is what you have to review this useful life and residual value also. And you took that residual value 20,000 a year. In the fifth year, you got to know that the 20,000 also can't able to recover, that would be zero. Then that change from this year should be prospective. I hope you understand this point. And then so you should review this residual value and useful life and each financial year end, and then account accordingly. And then residual value should greater than the carrying account. Say suppose uh, you accrued that asset PPE, and during the period of the depreciation time in the sixth year, you calculated your depreciation, total accumulated depreciation is 90,000, but and you have a residual value of 20,000. So in this situation, okay, I will give with proper example. Okay, this is first year, you acquired for 1 lakh, and then residual value, you assumed residual value is 20,000. So you should calculate depreciation for each year. You say suppose you follow SLM basis, the first year, second year, third year, fourth year, fifth year, like this. So this is the opening accumulated asset and all. So gross value you can know. So accumulated depreciation I am scheduling. So what is the depreciation? Our formula is 1 lakh minus residual value 20k, useful life 10 years. 10 years. So 1 lakh by 20, 80,000 by 10, 8,000 is your depreciation for the first year. In the second year, another 8,000. Third year, another 8,000. Fourth year, another 8,000. Fifth year, another 8,000. So 40,000 till fifth year. The sixth year, you revalued your asset. So you assume that your carrying value should be 20,000 only. So you revalued your asset to 20,000. The residual value is also 20,000. Okay. Then your depreciation is zero. In that case, if your residual value is greater than or equal to your carrying amount, in that case, depreciation charge should be zero, because you can able to recover that amount, this 20,000, in at the end of the 10th year, because you revalued your asset in the sixth year. Because then you cannot at that revaluation amount you can able to recover in the residual value, or else in any cases, if your residual value is greater than or equal to your carrying value is 40,000, because 1 lakh minus this 40,000 depreciation, the 60,000 is your carrying value, and you revalued this to 20k. So your carrying value is greater than or sorry, your carrying value is less than or equal, or else residual value is greater than or equal to carrying value of the PPE, the depreciation should be zero, unless until residual value is less than in the carrying amount. Say suppose you revalued this asset to 20k. In the next year, you revalued that asset to 60k. Then you can start depreciation in the next years. Even though if your carrying value is, say suppose this is your carrying value is 1 lakh, and your fair value for that asset is 3 lakhs, and your residual value for that asset is 50,000. Okay, this is the situation. Here your residual value is less than or equal to your carrying amount, because this is less than it, but your fair value is greater than your carrying account. Fair value is greater than your carrying amount. In the situation, practically the entity will revalue your asset. But if you do not revalue in that particular year, you should not stop depreciation because of your fair value is more than your residual value or more than your carrying value. You can assume that, so my fair value is more than my carrying amount, so I should not depreciate. You cannot assume that case until you get the depreciation, until you revalue the asset. So still you need to change the depreciation, you need to charge the depreciation until the residual value is more than the carrying value. Until you get this case, you should charge depreciation even though the fair value is more than your carrying account. You cannot still that stoppage of depreciation because of this situation. I'm just. And the fourth point is commencement of depreciation. When we start, when PP is available for use, capable to operate in a manner intended by the management. Whenever your intention is reaches, then you start the depreciation for that particular asset. And when you cease the depreciation, the cessation is earlier of, thus the asset is classified as held for sale, or the you should de-recognize that date. In that case, you should stop the depreciation. So commencement, when you reach the intention, when you reach your intention, you can start the depreciation. And whenever your intention is fails and you transfer that asset to held for sale, in that case you stop the depreciation. That is what the standard suggests. So if you meet your intention while you calculating the uh, depreciation, you start it. When you stop your intention, you can mark it as an L for sale, you can stop it. So or else you de-recognize this asset. Say suppose your intention is good but you want to de-recognize it because of the damage. In that case also you de-recognize its value. So you should stop the depreciation, but you should not cease the depreciation when asset is idle. Because say suppose you have a non-production mission, and in January month and February and March and June you have used it, and suddenly from April to next March, in the next financial year you didn't use that mission because of the low demand. So your closing stock could use it for your survived your purpose in the next financial year. Because of the low demand you didn't use that mission. In that case, still you should charge the depreciation. You should not stop that because of this situation. So because of the low production or low yield demand or not in the active use, so still you should charge the depreciation to the particular PPE. I hope you understand this standard till now. In the next classes we will see what are the depreciation methods available to us. What are the depreciation methods, like how many depreciation methods we have? Say straight line method, diminishing return down value method, or else residual value method, or else production usage method, and which method we should use, that and that we will do in the next classes. Post that we will see the appendix A, and then impairment situations, and then derecognition situation, everything in the previous channel. Thank you for watching till now, and if you feel we are putting efforts for explaining the standard, please subscribe our channel and share to the friends wherever your friends whoever required. Thank you.